Good morning, students. Welcome to all of you at ICAI CA Tube channel. Today we are going to deliver the second lecture on accounting for employee stock option plans. As we have already covered the basic concepts of employee stock option plan and few questions we have also done in our previous lecture. So first of all, I would like to see how many are present. So send good morning so that we can understand how many are present in the today's lecture. Yeah, welcome Harsh Goel, good morning. Sushil, good morning. Very good. Those who are present, send good morning so that we can understand how many are present. Be at time, that's really good. Sushil Kumar is before time, comes first always. So that's good. Harsh Goel, welcome. All of you, welcome. So, first of all, if there is any doubt in the previous lecture, or if you have any issues in the previous lecture, or whatever the illustrations or questions you have done, I would like to take the problems of those having any problem in any of the illustration, any of the questions which you have done. I have also uploaded questions from my side, few additional questions which have appeared in your last examinations in employee stock option plans and buyback of shares, because the next lecture is buyback of shares and I have already sent the examination questions of both the chapters combinedly. So you may find out the questions of each chapter and do that. So beta fast, very good. Good morning. Ilavarisi, good morning. Vandana, good morning. Rafiq Bhai, good morning. Anitha, good morning. Charu, good morning. Mohammed, good morning. Vinod, good morning. Ravila, good morning. Renuka, good morning. Very good. Halit, good morning. Everyone, good morning. Very good. So that's really a nice morning. How is the temperature in your area? Expecting a lowest temperature nowadays. It's running. So having a cool good morning. Now, having any doubt, illustration number 6, Rohan Jain. We will do that illustration today. Welcome. Good. Illustration 6, 7. We will do. Very good, Harsh Goel. Question number 5 of assignments. Assignment means which I have sent to you now. Question number 5. Okay. We'll do. Question number 5 noted. Illustration number 6, 7 noted. So let's start with illustration number 5. Beta, you have done? Have you done illustration number 5? Tell me. Illustration number 5. Have you done it? If you have already done illustration number 5, I will start with 6. Otherwise, I would like to go for 5, then 6, then 7. Tell me whether you need any assistance in illustration number 5 or not. Illustration number 5. Yes, sir. Very good. Dear sir, why is this chapter very important from practical point of view? So actually, whenever we are talking about any company in all over the India, specifically, nowadays every company is going into startups. And when a new startup comes into the existence, how they are arranging money from the public, from the bankers, from the resources, whatever is available with them. A startup has been started. Now they need money. They will go to banks. Banks will not fund them because funding can be given only to those which have some good history of good earnings and more expectations in futures. Now startups have a great risk. You will go to the public that I need money, you may take up my shares. No one is interested to take the shares of startups because they know that there may be a chance of a big blunder, there may be a chance of big loss, there may be a chance of big closure later on. So no one is interested to work with them, no one is interested to fund them. But While talking about employees, let's say I am working in a company which is newly started. I worked with that company for 6 months. Now I am the real person who can analyze that what will be the future of this company. If I am a technical person, if I am a knowledgeable person, I have a faith in myself, I have a faith in my knowledge, I can easily understand that what is the future of this company. If the owners are good, they are working hard, if they have a good plans, and they are maturing their plans within a very short span of time, and long goals are also there. They are also planning for the long goals to be achieved by achieving short goals first, and earning prospect is also high in future. And while working, I come to know that these are the good persons, these can work in long term, in long run they will be the good earners. So I may invest in their company, I may invest in their company. No, I doesn't have money, but I may invest in their company. So in that case, those startups are trying to get money from the own resources. Their own resources are their employees. So they are issuing shares to their employees by way of, I would like to give an example in this. Let's say a new startup is there named as Paytm. When Paytm was started, it was a new startup. Everyone knows. Now, Paytm, I'm working in Paytm. I'm expecting that they may earn good in future. Now, Paytm offers me a salary of rupees 35,000 per month. Now, normally a person is not interested to work at a lower salary. Normally, a person is not interested to work at a lower salary. But in case he thinks that the future of the company is high, he may work with them. So if I think that their future is high, I may work with them. Now they need permanent employees because the employee which knows their product can easily work with them for long term. So to keep the employees with them for long term bonding of the employees, plus insist the employees to work with them at a lower remuneration. Otherwise, if I'll go for any other company, I may easily get 45,000 or 50,000. Assume it. Now it means for I am losing rupees 10,000 per month. But company offers me shares in their company. This Paytm has offered me shares in their company, which I will get after 2 years. Vesting period alternative remuneration. I'm getting this alternative remuneration is what this is alternative remuneration of employee stock option plans that I am getting from the company. So due to that reason, I may work with them for long term. Now, what it is, this is the latest future of our company. This is the latest trend in our company that startups are coming. Obviously, every startup is issuing shares to their employees. So you should have to know the practical aspect of this thing that we are doing. Good. It was done in class. Very good. Illustration number 6. Sorry, we will do illustration number 6, beta. Sorry, illustration number 2. Why entry for remaining 24th on employee stock option stock employee compensation expenses. Okay. See illustration number 2 also. Having a doubt to Charu. Yeah, Charu, please check. All must see because question asked by any student is well beneficial for everyone. So bank account debit 24th on. This is the entry of 24th on. No other entry of 24th on is there. Why entry for remaining 24th on employee compensation expense? Okay. Illustration number 2. Yeah, this is rupees 24,000 in this case. What it is? See the question. You may easily understand the concept. Yeah, here is list number 2. So he says ABC Limited grants 1,000 implies stock options to its employees at 40. Market price is 160. Fair value is 120 per option. Fair value per option. Vesting period is 2.5 years. Maximum period is 1 year. Maximum exercise period is 300 unvested options lapsed on 1st of July, 1st of May. 600 are exercised on 30th of June. So this is the point which is important here. 600 options are exercised on 30th of June. That means for employees have purchased only 600 options. I have given them the option to purchase 1,000 ESOPs, employee stock options, but they have purchased only 600 because 300 are already expired, 100 are later on expired. So only 600 shares or 600 options are purchased by them at the price of rupees 40 because I have given them the option at the price of rupees 40. So obviously 600 into 40, that is 24,000, which is to be which is to be which is to be entered here. Second query by Charu is okay. In illustration number 2, remaining loss of 24,000 for half year, why not written off as 48,000 is written off for first year? Very good. First of all, see how much is the loss in this case. See, 1,000 stock options are given and the loss is 1,000 into 120 and the period is 2.5 years. So we have already discussed that stock options are to be treated in this way, that 1,000 stock options at the rate of 120, it is 1,20,000 total loss for 2.5 years. So it is 48,000 for 1 year. So 48,000 for 1 year. Now it is to be written off in this way. See, we have issued this on 1st of April 2010. So in 2010-11, we will write off 48,000. In 2011-12, we will write off 48,000. In 2012-13, we will write off 24,000 as it will be of 6 months only, as already clear to everyone. Now we have written off 48,000 in the first year because no information is available up to 1st of May. Up to 1st of May, everything was normal. 1st of May. So 1st of May meant for everything was normal in 10-11. So we have written off it. In 11-12 also there is no issue. So we have written off full amount. But on 1st of May, I come to know that 300 options are lapsed. Means 300 losses of 300 shares are not required to be written off. How much loss is to be written off, that we have to check. Then 600 options are exercised on 30th of June 2013. So in 12-13, there is no other information available with us. But in 12th we have to write off 24th as per our calculation. But now we have to recalculate the loss to be written off. Actually, this 1/3 options are changed to 700 options now. Now 1/3 options are not to be written off. 1/3 no options are not to be purchased by the employees. Instead, we are expecting only 700 options are to be purchased by the employees. So we have a loss of rupees 120 on that. That is 84th on beta. Charu, it will be 84th on that will be loss which we have to return off. But we have planned earlier 1,20,000 because it was 1,000 shares which was to be purchased by the employees according to us on 1st of April 2010. But on 1st of May, the scenario is changed. On 1st of May, we come to know, means in the year 1213, we come to know that 300 shares will not be purchased by the employees. So how many will be purchased by the employees? 1,000 minus 300, that is 700. So how much maximum loss we can write it off? That is 84,000. We have already written off 96,000 loss. Is that clear? 48,000 in the first year, 48,000 in the second year. We should have to write off 84,000, already written off 96,000. So 20,000 is 12,000 is to be reversed. Whenever it is to be reversed, it will be transferred to general reserve. It will be transferred to general reserve. Employee stock option, employee stock compensation, outstanding account debit to GR. That entry will be passed. Is that clear, Charu? So due to that reason, this 24th one will not be written off now. Even in the next year, there is a change. In the next year, he says 100 options are further lapsed because he says 2.5 years is the vesting period and 1 year is the exercise period. So it means for it will also go into next year. But in next year, there is no need of writing of any loss. In 13-14, there is no need of writing of any loss because losses are already written off. In the next year, we find that only 600 options are purchased by the shareholders, by the employees. So 600 into 120, that is 72,000 is to be written off. Instead of this 1,000 or this 700, we have to write off only 600 losses on 600 shares. That is 600 into 120. But we have written off how much? We have written off 84,000. So what we will do? We will reverse this 12,000. So this will be reversed. This will be transferred to general reserve. Is that clear, Charu? Very good, very good. So coming to illustration number 6, beta. Read illustration number 6, everyone. Intimate others that you are getting benefit by attending these lectures. Whomsoever is your friend doing group 2, he must have to attend the lectures regularly. This is your duty to help them, to guide them, to assist them, because thousands of rupees to get training, get coaching. So if someone can help them, that you may save your money and use that for getting practical training or practical knowledge, because practical knowledge is much more required in comparison to this. This is for passing the exam and that is for practicing in future. So your future can be secured by using that money. So tell others that you must have to join these lectures. Let's start with the illustration number 6, beta. Come to illustration number 6. It is Choice Limited granted 100 stock options to each of its 1,000 employees on 1st of April at the rate of 20, depending upon the employees at the time of vesting of option. So 1,000 at the rate of 20 we are giving. It is to be exercisable within the 1 year when it is vested. The market price of the share is 50. These options will vest at the end of year 1 if earning of Choice Limited is 16%. This is the condition. I have made a condition to our employees that if you will work hard, if you will work hard, obviously company will earn better. If company will earn better, then company will give you these stock options. Otherwise, you will not be able to get it. So these options will vest at the end of year one. You will get this at the end of first year only. If our percentage of profit earning is 16%. If no, then it will vest at the end of year two. If our average earning of first and second year is 13%. And if these two things not happen, then at the end of third year, there is a chance we will give you this option. If our average earning will be 10%. So I have given you three options. Either you may get it at the end of first year or at the end of second year or at the end of third year. Python unvested options lapsed on 31st of March 2012. Now he says another thing is there. We have given 100 stock options to 1,000 employees. So it is 1 lakh shares. 100 stock options of its 1,000 employees. So 1,000 into 100. It is 1 lakh shares we are going to give them, out of which 5,000 unvested options lapsed on this date. On 31st of March, 4,000 unvested options are further lapsed on this date. Finally, 3,500 unvested option lapsed on this date. Fair value of the option is 30, as we have already seen. Market price is 50, option price is 20. So fair value is 30, means the loss to be borne by the company per share will be 30 rupees per share. Now, in the first year, what happened? In the first year, 14% is our earning. We have already tell to our employees that you must have to work hard and we must have to earn 16% minimum. If we will not earn 16%, we will not give you the right to purchase these options. Then another year, in next year, we have given them an option that you may earn this, you may get this. If your earning is average 13%. So it is 10% in 31st of March 2013. And then he says in the next year it is 7%. So that is given to you. So that is given to you. Now, further 850 employees exercise their vested option within a year. And remaining options were unexercised at the end of the contractual life. Means some options are lapsed and some employees have not opted for the options, because 150 employees are already not going to apply their option, because only 850 employees are going for the options. So this is the information given to you. Let's understand the concept one by one. Now he has given you the information that these persons will get shares in this case, but this is not our calculation. They have to check it out, that whatever is the expectation, whatever they have earned. Final thing is given to us that 850 employees have gone for the options. Means, in simple words, illustration number 6. He says 1,000 employees are there and we have to give them 100 options each. So we have to issue 1 lakh shares at the rate of rupees 20 per share. This is the first thing per option, I can say. One and the same thing option, but these are named as option until these are not issued. Once these are issued properly, these will become shares. Options. Now, when these will be issued, when these are this offer is given to the employees, at that time, these 1 lakh shares will, due to issue of these 1 lakh shares, company will have to suffer a loss of rupees 3 lakh. Now, how much is the vesting period? How much is the vesting period? He says vesting period is practically 3 years. With the option would be exercisable within a year when it is vested. And what is the vested system? Vesting system is if company will earn 16%, then vesting period is 1 year. If company will earn average 13%, then vesting period is 2 years. If company will earn 10%, then vesting period is 3 years. But this is not our way of working. We doesn't have to consider, we doesn't have any consideration of whatever the percentage is there, because that all calculations will be on independent basis and that will be made by the company. So it doesn't recognize this thing that how much is the earning of the company, how these are lapsed, how the we will go for the hardcore information that is given to us that 5,000 options were lapsed on 31st of March. We will go accordingly. 4,000 unvested options lapsed on 31st of March 2013, and finally 3,500 unvested option lapsed on 31st of March 2014. So that is the information given to you, and we have to go according to that information only and only. We doesn't have to consider anything else. So let's take with years. Now, we have planned to issue 1 lakh shares and suffered a loss of rupees 30. But at the end of year one, what will happen? At the end of year one means he says we have planned this option on 1st of April 2011. Now in 11/12, that is on 31st of March 2012, 5,000 unvested options lapsed. That we have to work out. If 5,000 options are lapsed, that means for in 2011, 2012, how much options are going to be exercised, that we will have to assume that how much will be the total loss borne by the company. Company is not going to borne loss on 1 lakh shares, 1 lakh options, as on this date, 1 lakh minus 5,000, only 95,000 are expected to be issued. So we have to suffer a loss of 95,000 into 30. It is 28 lakh 50,000. So we are expecting a loss of 28 lakh 50,000. So this loss is to be borne by us within the period of how many years? See the period. Period is given to you. Twenty-eight lakh 50,000. The vested option within a year. Okay. This is on 1st of April 2011. So calculation of period is with you, 1st of April 2011. So we have 3 years with us, 11, 12, 12, 13, and 13, 14. So these are 3 years with us. We have to write off our losses according to this. Vesting period is here 5,000 into 30 divided by just a moment. Compensation expense will be 95,000 options are there, na? 850. Read the question once again. As he says, for 20, depending upon the implies at the time of vesting of options. Option would be exercised within a year when it is vested. The market price of the share is given to you. These options will vest at the end of year 1 if the earning of choice limited is 16%. It will vest at the end of year 2 with the earning of the 2 years is 13%, and lastly, if the average earning of 3 years will be this. Unvested option lapsed on 31st of March, and fourth on unvested option lapsed on. I think there is some error in module. Let's do according to the system, whatever the real system is, because I think that there may be some error. We will check it out and then tell you. It should be 28,50,000, and option is to be used within the period of 3 years. So divided by 3 should be there, divided by 3, because it is the loss is to be written off within the period of 3 years. So divided by 3, it should be 9,50,000. In the first year, it is to be written off by rupees 9,50,000. According to my calculation, just I will check it out later on and tell you tomorrow in the next lecture also if there is any change. Otherwise, it should be like this, because it should be divided by 3, because vesting period is 3 years. That has been clearly mentioned in the question. He has already mentioned you that the vesting period is 3 years. These options will vest at the end of year 1. If the earning of choice limited is 16%, and according to my opinion, this should be. Let's do accordingly. Then I will review it in the next lecture if there is any change. I will check it out and then tell you. Otherwise, it should be done in this way. Divided by 3. So it should be 9,50,000 in first year. In 2011-12, it should be 9,50,000. 50,000. Now in the next year, what has happened? In the next year, in 2012, 13, what has happened? He says further some options are lapsed. See how many options are lapsed? 4,000 unvested options are lapsed on 31st of March 2013. So it means for now, out of 1 lakh, 9,000 options will not be exercised. So 95,000 shares are expected to be issued. So the loss to be written off should be 95,000, 91,000 into 30. It should be 27 lakh 30,000. Already how much loss is written off by us? And how much loss is to be written off up to this date? Let's see that 27 lakh 30,000 is to be written off during the total tenure. 27 lakh 30,000 loss is to be written off during the total tenure. How much is the tenure? Tenure means vesting period. Vesting period is 3 years, out of which 2 years are expired up to 2013. Up to 31st of March 2013. How much period is expired? 2 years are expired. So how much is to be written off? 27 lakh 30,000 into 2 by 3. It is to be written off. So how much it is? Into 2 divided by 3. We should have to write off 18 lakh 20,000 up to this date minus already written off. How much is already written off? According to my calculation, it is 9 lakh 50,000. In ICAI module, it is given in a different way. So let's do according to this 9 lakh 50,000. So it is 8 lakh 70,000 to be written off in this year. In the second year, we should have to write off 8 lakh 70,000. Is that clear? And then we have to go for the third year. Is that clear to everyone? Please note it down because that is not, it is given in your module in a different way. So in third year, what will happen? In third year, he says 3,500 further options are lapsed. Means out of 91,000, further 3,500 options are lapsed. So it means for we have only 87,500 options better to be continued. And the loss is rupees 30 per share, which is to be written off during the total tenure. And total tenure is, we know, 3 years only. That is 26,000, 26 lakh 25,000 only. How much is already written off? That you have to check. Total amount to be written off 26 lakh 25,000. Maximum amount to be written off. This is the maximum amount to be written off. Because third year is also over now. This is proposed to be written off. At the end of 3 years, total amount to be written off is 26 lakh 25,000. Already how much amount is written off? Obviously, in the first year, we have written off some amount is written off in the second year, and finally, whatever is the total amount to be written off, that will be done in the last year. So in the first year, we have written off 9 lakh 50,000. In the second year, we have written off 8 lakh 70,000. That is total we have written off 18 lakh 20,000 beta. So in the third year, you should have to write off 8 lakh 5,000 beta. So total amount to be written off is 26 lakh 25,000. and the last year, that is in the third year, we have to write off 8,05,000. 1 lakh at the rate of 30 is equal to 30 lakh. What I have taken, beta? Okay, sorry. But we have done according to 30 lakh only. Is that clear to everyone? I expect that there is some error in your module. I will check it out and finalize it and tell you in the next lecture. You may go according to this. Copy it so that I can proceed to the next one. Accordingly, journal entries will be made. Can it be because of company is going to vest at the end of year 2 if the average earning of 2 years is 13%? We don't know the profit for the next year. Sir, while accounting for 31st March, how can we conclude on the basis of earning in 2003 and 2004? While accounting for how can we conclude? Actually, earnings are not given to you. You have been given earning of 14% in the first year. So as earning of 14% is given in the first year, but we are expecting it at 16%. We may assume that we may achieve the target in the next year. If we may achieve the target in the next year, obviously in that case we should have to write off the total loss within the period of 2 years only. But this is not for sure. This is just an assumption. So that assumption we may go for it. But if that is not achieved, then we have to go for the third assumption. Now, if all the assumptions are not achieved, even then we have issued the share. Just check it out. How much is our earnings? How much is the earning? Here it should be 16%. Not achieved. Here it should be 10 plus 14 divided by 2. 10 plus 14 divided by 2 is 12%. So not achieved because we are expecting 13% here. So again, it is not achieved. Then in the third year, how much is the expectation? Our expectation is 10%. So it is 16. It should be 14. See how much is the actual calculation? 14 plus 10 plus 7. So it is 31 divided by 3. So it has been achieved at the end of third year, 10.33%. And we are expecting 10%. We are expecting 10%. At the end of first year, we doesn't know that whether we will achieve our target in the second year or third year. Now, there is an assumption of conservatism approach that tells us whenever we are expecting any loss in future, we may write it off. Now, we may assume that we may achieve this target in the second year, and hence loss can be written off in that way. In that case, what we will assume? Here we are taking an assumption. We are assuming that our target of earning must be achieved in 3 years. In module, the assumption is taken that target is achieved at the end of the second year. So if we will assume that the target is achieved at the end of the second year, then what we will do in this way? we will go for the next one. If at the end of year one, you must have to note it down. You must have to give this assumption also. That is not given in the module, but you should have to give it. If at the end of year one, we have assumed that we may achieve earning target at the end of second year. That is given in the module. So accordingly, total loss of 28,50,000 may be written off within the period of 2 years. So due to that reason, they have done 28,50,000 divided by 2. Divided by 2. So it is 14,25,000. Now, but this target is actually not achieved at the end of the second year. So what you have to do is you have to take another assumption at the end of second year. At the end of second year, this is on 31st of March 2012 assumption. Then on 31st of March 2013, we have to take another assumption, that is at the end of year 2. Another assumption is taken. We may achieve our earning target at the end of year 2, year 3, sorry, at the end of year 3, because in the second year we are unable to achieve this target. We expected that we will achieve this target in the next year. So if we will achieve this target in the next year, then the total loss of rupees 27,30,000, that is 95,000 options are to be exercised at the rate of 30 each, is to be written off within the period of 3 years. So it will be 2 by 3. In that case, it will be 18,20,000. Already written off 14,25,000. It doesn't make any problem. You may do anything because this is just a provision which is to be created. This is just a reserve to be created. And this is just a taxation implication which will change. Assumption is according to us. Whatever assumption we will take, that will be good, because this is not actual thing. Actual thing will be done only at the end of third year. Total loss to be written off only at the end of third year, 3,95,000. But at the end of third year, picture is very much clear. At the end of third year, what has happened? Target is achieved. Total loss to be written off is 26,25,000. Already written off loss is 18,20,000. So the balance loss of rupees 8,05,000 is to be written off. Sir, while accounting for, how can we conclude on the basis of earning in 2013? Just it is an assumption, because this is a conservatism approach which has been used here. Conservatism approach, which tells us provide for all probable losses, never provide for, do not anticipate gains. At the end of year 1, it is assumed that vesting period is 2 years. I think that why in year 1 total loss is divided by 2. Exactly right, beta. On 31st of March 2012, we already know target not achieved in first year. So going for second option of second year. Now clear, sir. Good, very good, beta. Very good. Your mindset is okay. There's no problem. Whatever he is doing and whatever you are assuming, that is correct, beta Harsh. There's no problem. So no need of discussing in the next lecture. This is clear in this. illustration number 7 we may do. Having any doubt in this, we may discuss. Otherwise, I will go for illustration number 7. Could we go for illustration number 7? Illustration number 7. A good illustration. If you will see, at the beginning of year 1, an enterprise grant 10,000 stock options to a senior executive, conditional upon the executive remaining in the employment until the end of year 3. So conditional is this, that they must have to remain in employment up to the end of year 3. Exercise period is 40 rupees per share. Exercise price drops to 30 if the earning of the enterprise increase by at least an average of 10% per year over the 3-year period. Means two conditions are there. First condition is they must have to remain in employment for the next 3 years. Second point is that if the earning will increase, the price at which it will be given to the executive will be reduced. Means he will be benefited if that earning is achieved. On the grant date, the enterprise estimated that the fair value of the stock option with an exercise price of 30 is 16 per option. On the grant date, the enterprise estimated that the fair value of the stock option with an exercise price of 30 is 16 per option. So this is a loss which we are expecting. If exercise price is 40, then the loss we are expecting is 12 rupees per option. So it all depends on the future trend, whatever the future trend will be there. So during year 1, the earning of the enterprise increased by 12%. So he says if the earning of the enterprise increased by at least an average of 10% per year over the 3-year period, means in the first year target is achieved. But in the first year target is achieved because earning is increased by 12%. So if earning is increased by 12%, obviously in that case, we may assume that the loss is going to be 16 rupees per option, not the 12 rupees per option. Then in the next year, we expect that the increase will continue. The enterprise therefore expect that the earning target will be achieved and hence the stock option will have an exercise price of rupees 30 per share. So at the end of second year, what will happen? It again increased by 13% and enterprise continue to expect that the earning target will be achieved. So again, good thing is there. Again, the total loss what we are expecting, it should be 16, not the 12, because the price at which it will be given to the executive will be 30, not the 40. During third year, the earning of the enterprise increased by only 3%. So whole thing is abolished now. He says the exercise price is 40. However, the exercise price drops to 30 if the earning of the enterprise increased by at least an average of 10% per year over the 3-year period. Now, what is the average? By at least an average of 10% per year. So it is increased by 3% only in the third year, and therefore the earning of the enterprise, therefore the earning target was not achieved. Obviously it is not achieved. Executive completes 3-year service, but he has completed 3-year service, hence he will be entitled to get the shares and therefore satisfy the service condition. Because the earning target was not achieved, the 10,000 vested options have an exercise price of rupees 40 per share. Required to calculate the amount to be transferred to P&L account every year on account of compensation expense. Very simple and easy to understand if you will think properly. Now, Since the excess price varies on the outcome of a performance, which is not a market condition, the effect of the performance is not considered when estimating the fair value of the stock option at the grant date. Instead, the enterprise estimates the fair value of the stock option at the grant date under each scenario and revise the transaction amount to reflect. Means whatever we have discussed, that will happen. So at the end of first year, we are expecting a loss of 16 per share. Vesting period is 3 years, so it is to be written off by multiplying with 1 by 3. So the expenses for the first year to be written off is 53,333. In the next year, what has happened? Again, the target is achieved. So we have expected that the loss will be 16 per share instead of 12 per share. So how much is to be written off in maximum? Maximum we have to write off 2 by 3 because this amount is to be written off within the period of 3 years. And because vesting period is very much clear, that is 3 years. So accordingly, we should have to write off this within the period of 3 years. So at the end of first year, we have to write off 1 by 3 amount. At the end of second year, how much is to be written off? Maximum written off amount should be 2 by 3rd. At the end of third year, target is not achieved. So if target is not achieved, what we have to do is, we have to write off according to 12 per share. Now total amount is to be written off 1,20,000. So at the end of first year, we have to write off this. At the end of second year, we have to write off this much amount. This is at the end of first year. This is at the end of second year. So at the end of third year, how much is to be written off? At the end of third year, total amount is to be written off 1,20,000. That is clear to us. Minus 1,06,667 is already written off. How much balance is to be written off? That is 13,333. See once again. At the end of first year, 10,000 shares are there. Loss is 16 per share. So total amount to be written off 1,60,000. So 3 years is the vesting period divided by 3, 53,333. This is the amount to be written off at the end of first year. At the end of second year, again same assumption is there because target is achieved. So 1,60,000 is the total amount to be written off within 3 years. Within 2 years, how much is to be written off? 1,06,667. Already we have written off 53,333. So the balance amount of 53,333 is to be written off at the end of second year. At the end of third year, the provisions are changed. We come to know that the maximum loss to be borne by the company is 1,20,000, not 1,60,000. So period is already over. We have to write off the total loss in the third year. Already we have written off 53,333 in the first year, 53,333 in the second year. So the balance amount of rupees 13,333 will be written off in the third year. Is that clear to everyone? Is that clear to everyone? One time explain. Rafiq bhai, just tell me once again if you are not clear. Rafiq bhai, I am waiting for your answer. Do you need one more explanation or is that okay? If you require it, just tell me. Is that clear to everyone? Illustration number 7. Any doubt in illustration number 7? Tell me. If anyone needed any assistance in this illustration, please tell me. Otherwise, I am going to illustration number 6 once again because few students are asking to let me clear on that once again. Vandana says clear. Vinod says clear. Everyone says clear. In illustration number 6, explain. Yes. Come to illustration number 6 once again. Yes. I'm reviewing the illustration number 6. Choice limited grant 100 stock options to its employees. 1,000 employees are there. So it's clear 1 lakh shares are to be issued. 1 lakh at the rate of 30 per share. That is also clear because this is a total loss to be borne by us, 30 lakh. Because option price is 30 and 20 rupees is the price at which it will be issued to us. Now he says it will be given to the vesting period will be 1 year only. In case our profit percentage is 14%, our profit percentage is 16%, but we are unable to achieve that target at the end of year 1. So if we are unable to achieve the target at the end of, if we have achieved the target at the end of first year, what will happen? If the profit percentage at the end of first year is 16% or more, what may happen? In that case, we will issue all the shares to the employees at the end of year 1 only. Vesting period will be 1 year only. If vesting period will be 1 year only, then the total loss of rupees 30 lakh is to be written off at the end of first year only. Is that clear? But this hasn't happened. This has not happened. Instead, what has happened? This has not happened. What has happened, beta? We have achieved 14%. So the target is not achieved. So vesting period is increased to 2 years or 3 years. Vesting period is increased to 2 years or 3 years because he says it will vest at the end of year 2 if average earning is 13%. Now at the end of year 2 on 31st of March 2013, we will come to know whether the position is achieved or not. Till that time, what we have to do? I am giving you a concept. If at the end of year 1, we have assumed, that is to be given, that we may achieve the earning target at the end of year 2, if we will assume this thing, then obviously total loss is to be reimbursed within 2 years. Or if we are assuming that our target of earning will be achieved in 3 years, if we will assume that the target of earning will be achieved within 3 years, then what we will do? We will write off the loss in 3 years. That is all up to our assumption. What we will assume, that is all up to our assumption. We will not, this is not given in the question. This is not given in, at that time because this is all about future expectation, future happening. अरे भैया फ्यूचर में क्या होगा मुझे क्या पता? वो कह रहा है पहले साल के एंड में अगर हमने टारगेट अचीव कर लिया तो वेस्टिंग पीरियड खत्म, दूसरे साल के एंड में अचीव कर लिया तो वेस्टिंग पीरियड खत्म, तीसरे साल के एंड में अचीव कर लिया तो वेस्टिंग पीरियड खत्म, नहीं तो शेयर ही नहीं देंगे. देखा जाए मीनिंग तो यही निकल रहा है. तो पहले साल के एंड में टारगेट अचीव नहीं हुआ तो कौन गारंटी देता है कि भैया सेकंड ईयर के एंड में हम अचीव कर लेंगे? नो वन कैन से गिव अ गारंटी. तो आपको एजम्पशन लेनी है बेटा कि क्या होगा फ्यूचर में. अब कोई पर्सन ये भी एज्यूम कर सकता है कि ये अचीव ही नहीं होगा जी टारगेट, तो ये तो अपनी एजम्पशंस पे है. अगर हम ये एज्यूम कर लेंगे तो क्वेश्चन ही खत्म हो जाएगा. तो हमें फ्यूचर में अच्छा सोचना होता है. अगर हम फ्यूचर में अच्छा सोचते हैं तो बेनिफिट होता है. तो इसीलिए मॉड्यूल में क्या किया गया? मॉड्यूल में उन्होंने एजम्पशन दे दी कि हम लोग ये जो टारगेट है ये नेक्स्ट ईयर के एंड में अचीव कर लेंगे. तो अगर ये एजम्पशन लेते हैं कि हम ये सेकेंड ईयर के एंड में टारगेट अचीव कर लेंगे तो हमारा जो टोटल लॉस है वो 30 लाख का तो नहीं है, क्योंकि 95,000 शेयर्स जो है वो एक्चुअल में लोगों ने लेने के चांसेस हैं. क्योंकि 5,000 शेयर्स तो देने ही नहीं है. वो क्यों नहीं देने? क्योंकि हो सकता है वो लोग जॉब छोड़ के ही चले गए हो, या उन लोगों ने खुद ही कह दिया कि हम लोग आपके शेयर बिल्कुल नहीं लेंगे, कोई हमें आपके साथ काम में हम लोग आपकी कंडीशन में नहीं रहे, हम तो अपने हिसाब से काम करेंगे. कुछ भी है, 5,000 शेयर होल्डर्स तो बीच में से निकल ही गए हैं. तो टोटल लॉस जो है वो आपका कितना है? 95,000 शेयर्स के ऊपर आपका टोटल लॉस जो है वो 95,000 इंटू 30 28,50,000 का है. अब फर्स्ट ईयर में कितना राइट ऑफ करना है? वो 2 सालों में डिवाइड कर लो। सो दैट इज डिवाइडेड इनटू 2 इयर्स, एज्यूमिंग कि अगले साल तक टारगेट अचीव हो जाएगा और वेस्टिंग पीरियड सिर्फ 2 साल ही रहेगा। हम तीसरे साल के एंड में शेयर नहीं इशू करेंगे, बल्कि सेकेंड ईयर के एंड में शेयर इशू कर देंगे। क्लियर है? उस बेस पर हम लोग 14,25,000 को राइट ऑफ कर रहे हैं। उसके बाद अब सेकेंड ईयर का एंड हुआ, टारगेट फिर नहीं अचीव हुआ। अब फिर वही प्रॉब्लम कि अब क्या करें। अब हम लोग ये मान के चल रहे हैं कि ये टारगेट तो हमारे से अचीव इस साल तो नहीं हुआ, हम उम्मीद करते हैं कि नेक्स्ट ईयर में अचीव हो जाएगा। उसके बाद तो चांसेस ही नहीं है अचीव होने के। तो हमने सेकेंड ईयर के एंड में ये अजम्पशन ले ली कि हम लोग ये टारगेट जो है वो थर्ड ईयर के एंड में तो पक्का अचीव कर लेंगे। ऑब्वियसली यही बात कह रहे होंगे इंप्लाइज भी तो हमें कि सर डोंट वरी, वी विल अचीव इट इन द नेक्स्ट ईयर। तो वेस्टिंग पीरियड हमें 1 साल और बढ़ाना पड़ गया। अब वेस्टिंग पीरियड कितना हो गया? 3 इयर्स हो गया आपका वेस्टिंग पीरियड। अगर वेस्टिंग पीरियड 3 इयर्स हो गया तो टोटल लॉस कितना हुआ? टोटल लॉस में अब हमारे पास जो 1 लाख शेयर थे उसमें से वो कह रहा है 5,000 तो अनवेस्ट हो गए पहले ही, 5,000 तो पहले ही छोड़ गए, 4,000 और छोड़ गए। तो अब सेकेंड ईयर के एंड में सिचुएशन क्या है कि मेरे पास 91,000 शेयर लेने की चांसेस है। अगले साल के एंड में जो शेयर लेंगे वो कितने लोग लेंगे? 91,000 शेयर्स लेंगे एट द रेट ऑफ 30 पर शेयर। मेरा लॉस होगा, जो टोटल लॉस मुझे बेयर करना है 27,30,000। कितने सालों में राइट ऑफ करना है? अब फर्स्ट ईयर बीत चुका है, सेकेंड ईयर चल रहा है और ज्यादा से ज्यादा 1 साल हो रहा है मेरे पास, तो 3 सालों में मुझे राइट ऑफ करना है। तो मैक्सिमम अमाउंट इस साल में कितनी राइट ऑफ होनी चाहिए? 2/3, तो इट शुड बी 18,20,000। तो 18,20,000 मुझे मैक्सिमम राइट ऑफ करना है। इसमें से ऑलरेडी 14,25,000 मैं राइट ऑफ कर चुका हूं, ये फर्स्ट ईयर में मैंने कर दिया था। तो बैलेंस 3,95,000 मैं राइट ऑफ कर दूंगा सेकेंड ईयर में। अगर सेकेंड ईयर में 3,95,000 राइट ऑफ हो गया तो अब थर्ड ईयर आ गया। थर्ड ईयर में मुझे क्लियर हो गया कि थर्ड ईयर में मेरे पास 1 लाख में से मेरे से 3,500 शेयर होल्डर्स और चले गए। 1 लाख माइनस 5,000 माइनस 4,000 माइनस 3,500, सो रह गए 87,500। सो 87,500 शेयर रह गए बस। अब ये 87,500 शेयर जो है के ऊपर टोटल लॉस इतना होगा अगर शेयर इशू किए जाते हैं। अब करने के नहीं करने ये क्लियर होगी पिक्चर। आप थर्ड ईयर में देख लो, थर्ड ईयर में हमारा जो रेट है वो कितना है? 14 प्लस 10 प्लस 7। सेकेंड ईयर के एंड में कितना हो गया था एवरेज रेट? 14 प्लस 10 डिवाइडेड बाय 2, दैट इज 12%। जबकि अचीव कितना करना था? टारगेट क्या था? 13%, तो अचीव नहीं हुआ। थर्ड ईयर के एंड में कितना करना है? 14 प्लस 10 प्लस 7 डिवाइडेड बाय 3, सो अचीव हुआ 10.33%। करना कितना था? 10%, सो अचीव हो गया। इसका मतलब हम लोग जो शेयर इशू करेंगे, इशू ऑफ शेयर्स, वो हम करेंगे थर्ड ईयर के एंड में, एंड ऑफ थर्ड ईयर। अगर ये ना होता तो हमें सारे का सारा लॉस जो है, जो हमने अभी हमने क्रिएट किया है, टोटल 26,25,000 का सारा ही राइट रिवर्स करना पड़ता। अगर मान लो ये टारगेट ही अचीव ना होता थर्ड ईयर में भी, तो हमें 26,25,000 को रिवर्स करके खत्म कर देना पड़ता। हम लोग कोई शेयर ना इशू करते, एंट्री होती इंप्लाई स्टॉक कंपनसेशन आउटस्टैंडिंग अकाउंट डेबिट टू जनरल रिजर्व। बट टारगेट अचीव हो गया। तो अगर टारगेट अचीव हो गया तो मैंने देखा कि मेरा टोटल लॉस जो है वो कितना होगा? 87,500 शेयर्स टोटल है मेरे पास। $87,500 शेयर मेरे पास टोटल है, इंटू 30, तो टोटल लॉस मेरा 26,25,000 हो गया। नाउ 26,25,000 में से मुझे क्या करना है? मुझे ऑलरेडी जो राइट ऑफ किया है मैंने 18,20,000 वो रिवर्स कर देना, वो कैंसिल कर देना। बाकी मैं अब कर दूंगा, बाकी मैं थर्ड ईयर में डाल दूंगा। So this is to be written off in the third year. So this is the concept which is followed in this case. Another assumption is we may assume that our target of earning must be achieved in 3 years. So if we'll assume this, we will go for the open-ended approach. In that case, what we will do, we will write off loss at the end of first year by dividing by 3. By dividing by 3. That is, we have assumed that this loss will be written off within 3 years. So it will be 9,50,000 in the first year. At the end of the second year, it is 18,20,000 divided by 3 into 2 minus 9,50,000. So balance is to be written off in the second year. Then actual target is achieved at the end of third year, 26,25,000 minus 18,20,000. Balance is to be written off in the third year. So this is all up to your choice, whatever you are interested to do. Better option is, according to, you must have to give note, whatever you are assuming. Whatever you are assuming, give a note. If you will give the note, the target is clarified. If you are not giving the note, then it is all up to the examiner what he will assume in his mind. As I am assuming different in my mind, ICAI is assuming different in his mind, so there will be a problem. Let's come to the conclusion that we should have to give proper note whatever we are assuming, my dear. So illustration number 7, once again, Pradhan is saying, Pradhan, let's do illustration number 7 once again, no matters. I need one favor from your side. I am discussing illustration 7 with you. You have to pass journal entries of illustration number 7 by yourself. Neither I am going to do it for you, nor it is given in the module. You may have to pass these entries and send to me. When we will discuss, I am giving you the concept, I am giving you the knowledge of concept. You will have to pass journal entry and send that journal entry to me now, immediately now. Okay, starting with that, it will help you to do the practice and solve the question within a very short span of time. Maximum time to be allocated this question is 15 minutes. Otherwise, because this question may come for maximum 10 marks. So if it will come for 10 marks, how much time with journal entries? This question will come for 10 marks with journal entries. Without journal entries, it may come for only 5 marks or 6 marks. So I am assuming it has been in exam for 10 marks. And you have already, I am with you. Obviously, we are doing help of each other. So you should have to solve it maximum within 10 minutes, not more than 10 minutes, my dear. So question should be clear to you. First of all, at the end of year 1, an enterprise grant 10,000 shares or stock options, what we are calling, to a senior executive, conditional upon the executive remaining in the employment of the enterprise until the end of third year. So this has been clarified to the executive. There, if you will work with us for 3 years, then at the end of beginning of year 1, an enterprise grants 10,000 stock options to a senior executive conditioning. We have given them an option with a vesting period of 3 years. Now, this vesting period is 3 years and the excess price is 40 rupees per share. He says price will be 30 only, means we will give them at a lower cost if he will do hard work and earn more. If his earning will be 10% per year, at least an average of 10% per year over the 3-year period, then it will be issued at rupees 30 only. Rafiq bhai, journal entry will be passed by you, which we have discussed in our previous question. Same entries will be passed in this. On the grant date, the enterprise estimated that the fair value of the stock option is 16 per option. Means company will have to bear a loss of 16 if price is 30. If price is 40, company will have to bear a loss of 12. Now, this is very much clear. So, condition is there, if average earning is 10% per annum, then issue price is rupees 30 and maximum loss to the company is rupees 16. If average earning is less than 10%, then issue price is rupees 40 and maximum loss to the company is rupees 12. So that has been made clear by him. Now, at the end of first year, what has happened? He says at the end of first year, earning is 12%. So we are expecting that we will achieve the target of 10% because it's a positive picture. If it is a positive picture, we may easily assume that for the 3 years we will achieve this target. So we have expected that the loss will be 16 per share instead of 12 per share, because shares will be issued at 30 in that case. So first year we are expecting loss of 10,000 into 30, it is 3 lakhs. Oh, sorry, 10,000 into 16. It is 1,60,000. Now, vesting period is 3 years. So this loss is to be written off within the period of 3 years. So first year, how much is to be written off? 1,60,000 divided by 3, it is 53,333. Is that clear to everyone? Now, in the second year, again, same thing is there, because in the second year, what has happened? We have earned 13%. So if, and the enterprise continue to expect that the target will be achieved. So if the earning is 13% and we are expecting that the target will be achieved, then obviously we will assume that the loss will remain same. That is, first year it is 53,333. Second year also it will be 53,333. It will remain same, because we are expecting that because the information is given, the question, assumption is already given in the question. We need not to take any assumption in this case. Assumption is already made clear. He says enterprise continue to expect that the earning target will be achieved. During year third, the earning increased by only 3%. Now, what is the average earning? If the earning increased by 3%, that means for first year it was 13%, it was 12%. Second year it is 13%. Third year it is 3%. 12 plus 13 plus 3 divided by 3. 28 by 3. So the average earning is 9.33. We need 10%. So target is not achieved. If target is not achieved, obviously the loss will be changed. In that case, our loss will not be 16, instead loss will be 12 rupees per share. It is the actual loss now because third year everything is completed, everything is over. So total loss is clear to us. It will be 1,20,000 only because shares are issued in this year minus actual loss minus loss already borne by them. 1,06,667. So 13,333. So this is a loss in the third year to be written off. Query by Harsh Goyal, very lengthy query. Employee compensation. Okay, these are the journal entries passed by. Very good, very good. So send me the journal entry of first year. First year, what journal entry we have to pass? Fast. Very good. Harsh, your first entry is correct. Your second entry is correct. Your third entry is also correct. Fourth is also correct. Fifth entry is also correct. Sixth is also correct. Now pass the final entry. When the shares are finally given to them, at the end of third year, shares will be given to them. So what will be the entry when the shares are given to you? Pass that entry also. Send all the students must send the entry. Just like Harsh, all the students must have to pass the entries by themselves. Very good, very good. Very good. Elaboration, very good. Abhijit, very good. Your entry is correct. All must have to pass this entry. I'm giving you 5 minutes. Pass these entries fast. Also, how it will appear in the balance sheet, you should have to know. In the balance sheet of first year, you should have to know where it is to be presented. It is to be presented in this way. Employee stock compensation outstanding 53,333 under the head liabilities. At the end of second year, obviously it will be doubled. At the end of third year, there's nothing which will be shown here. I missed transfer entry, please. Elaboracy, I'm not understood what you are interested to say. Do you need repetition of these entries? Harsh Goel, very good. You have passed the final entry also. All must have to pass these entries. I'm going to pass it for you so that you can check it out. employee first entry at the end of first year, employee stock option compensation expense account debit, employee stock option compensation expense account debit to employee stock compensation outstanding account. This is a reserve which has been created with the amount of rupees 53,333. First year and second year, same entries will be passed. Then second entry is profit loss account debit to employee stock option compensation expense account. It is written of 53,333. So this is to be passed at the end of first year and second year both. Same entry with the same amount. In the third year, we have to pass an entry. Employee, same entries will above same entries will be passed. Just the amount will be different. In the third year, entries will be passed with 13,333. Additional entry in the third year I would like to pass for you. In the third year, an additional entry. Bank account debit. When the shares are actually issued, options are actually issued to our employees, bank account debit, the price at which it will be issued. That is 10,000 into 40. 4 lakh. Employee stock compensation outstanding account debit with 10,000 into the loss which is to be borne by us into 12, 1,20,000. To equity share capital with the face value that may be given in the question. If it is not given, we may assume it as 10. So it will be 10,000 into 10. Is that given to you in the question? No, it's not given. So let's assume it as this. So it is 1 lakh to security premium. It is, we have issued these shares at rupees 40 per share. 12 is the loss which is to be borne by us. So balancing figure will go to security premium. 10,000 into 42. 4,24,000. Very good. Very good. Very good. Very good. Shabash, you have already done. Very good. Those who haven't done must do it within the break. So we will back after the break of 10 minutes. So be on time. We will go for the examination questions after this. Okay then. Sir, have a break ji. Ram ji. हाँ. So welcome back all after the break, all of you. Maybe you have already done all the journal entries of illustration number 7, assuming. But after fatafat, we have to do the examination questions. Have you downloaded my questions which I have sent to the ICAI? You have got the questions? So these are the examination questions, whatever is given to you. I would like to go for examination questions. Before that, if there is any doubt to anyone in the illustrations or question, I would like to take that. Then I would like to go for the examination questions, beta. I'm checking your queries. If you have any query, just send me fast. I'm checking your queries. Sir, what we have to do in illustration number 4? Just see illustration number 4 also. Once we should have to see it. Illustration number 4. Ajanta grant 120 share options to each of its 460 employees. Grant is conditional for Ajanta over the next 3 years. That if the employee will work for the next 3 years, only then this grant will be given to them. Ajanta has estimated the fair value of option is 12 per share per option. Ajanta estimated that 25% of employees will leave during the 3 years period and so forfeits their right to share options. Everything turns out exactly as expected. So 120 shares, 460 employees. Maybe I will do it here also. That's more better for you. No? 460 employees and 120 shares you have to give to everyone. So it is 460 into 120 is equal to 555,200 total options you have to give to them. Okay. Now he says there's a loss of 12 per shares. And also one more thing is given to you. The condition is vesting period is 3 years. The condition is very much clear that they must have to remain in the company for the next 3 years. Now company is very much clear that 25% of the employees will left the company within these 3 years. If the 25% of employees will left the company, obviously we may need not to create their provision. We need not to create any provision for them. So we are expecting that out of 55,200, 25% shares are not required to be issued. So minus 25%, how much shares we will issue? We will issue 41,400. That we are expecting. 41,400 at the rate of rupees 120 at the rate of rupees 12. The loss is rupees 12. So into 12. So the total loss, expected loss is 4,96,800, which is to be written off within 3 years. So divided by 3, 1,65,600. So this is a loss which is to be borne by them per year. So he says everything gone as expected. That is a later on point. First of all, at the end of first year, you will have to create this much as an expense and reserve, written off this to the P&L account. In the next year, also do the same. In the next year, that is the third year, you will come to know that the same thing has been happened. So the entry in the third year will also remain the same. In addition, one extra entry will be passed, that is bank account debit and this compensation outstanding account debit to share capital to security premium. So this is a simple concept in that case. So every year, same thing will be done. Is that clear? This is a query of Charu. Charu, is that clear? Charu, waiting for your answer. Is that clear, beta? Sonu Kumar Singh, in illustration number 1, why there is employee compensation expense account instead of employee stock option outstanding account. In illustration number 1. Let's see illustration number 1 if this is clear. Charu, are you sending me whether this inquiry is clear to you or not? So see illustration number 1. Why there is employee compensation expense account instead of employee stock option outstanding account. Okay, very good query. Very good query. When we need not to, we haven't any vesting period in the question. When we have no vesting period in the question, in that case, we need not to create a reserve, because reserve is to be created for future losses. If loss is occurred to us at the same time, or at same instance, then there's no need of creating a reserve and writing it off. We may directly transfer it to expense account. You may see that what entry we are passing. See what is this entry. We are passing these two entries. What we people are doing normally, we are passing an entry expense account debit to outstanding account, means that expense is debited and outstanding account is created. And later on, what we are doing, when the payment is received, bank account debited, outstanding account debited, to share capital, to security premium, that we are doing. So outstanding account is debited, outstanding account is credited and then debited. But there's a time lag. There's a time lag of 2 years or 3 years. This is the time lag due to the reason of vesting period. If there's no vesting period, what we may do? We may debit the expense directly, bank account debit to expense, because outstanding account is just created as a, you may say, to adjust the expense amount. This is already cancelled. When we are debiting it and crediting it, actually expense account is debited, bank account is debited to share capital to security premium. So there is no need of creating a reserve and then writing it off if there is no vesting period. See in the illustration number 1, there is no vesting period. A company has its share capital on 1st April. 10th on shares are, stock options are granted at ₹40, market price is 130. Options were to be exercised between 15th March and 31st March. That is in the same accounting year, because the date of issue is 1st of April 2011, and the options are to be exercised within the same year, that is 2011-2012. So if exercise is to be option within the same period, means we need not to continue that reserve for the next year, because what we are doing, we are using a conservatism approach. I am saying again and again, conservatism approach tells us provide for probable losses. Do not anticipate gains, means if we are expecting any loss in future, that is to be provided for now. But tell me one thing, if loss has occurred today, whether we need to create its provision first and then write it off. There's no need of it. If we are paying, if bad debts occur, what we are doing, we are passing an entry, bad debts account debit to debtor. But if bad debts doesn't occur and we are expecting that this bad debts will occur in the next year, we are providing for bad debts in the current year. And when that actual bad debts occur, we are adjusting that entry with that provision. So provision is required only when there is a vesting period, and that vesting period is not within the same year, that is in the next years. Then we have to create reserve, and finally we have to write off that reserve later on. Is that clear? Is that clear, Sonu Kumar Singh? Sonu, I'm waiting for your answer. Nagarjun. Yes, Sonu, any query? Everyone is clear on this concept? Have you downloaded my questions? I have sent you examination questions also. Let's see examination questions given to you. Good questions from, just see which type of question comes into your exam. Yeah. This question has come into your exam. Accounting for employee stock option plan. This is buyback question. Buyback. Yeah. This question has come in your July exams. July 2021. At the beginning of year one, Harmony Limited grants 600 options. That you have to do. Obviously, we have to do. At the beginning of year one, Harmony Limited grants 600 options to each of its 1,000 employees. Contractual life of options granted is 6 years. Means the total period is 6 years, in which vesting period is 3 years. Very important question. A different type of question has come into your exam. Just see how you can solve it. I have given you the chance to solve it. Have you done it? Whether you have done it, beta? 600 options of 1,000 to 1,000 employees. That means for 6 lakh shares we have to issue. Vesting period is 3 years. Vesting period is 3 years. Exercise period is 3 years. Expected life is 5 years. And exercise price is 100 rupees per share. Vesting period is clear to everyone. Exercise period is clear to everyone. Expected life is just when they will purchase these shares, how much period they will retain it. But that is not a technical problem for us. We need to go for this contractual period. That is vesting period 3 years, exercise period 3 years. Means, first of all, these will be issued after 3 years. And then they will be given an option to purchase it within the next 3 years. Market price is rupees 100 per share. And excess price is also 100 per share. So in this case, one more thing is there. One more thing is there, which is very important. He has not given you the fair value, the option granted vest according to the graded schedule. So that will be discussed later. First of all, see when the fair value is not given to you, how to do it. So if the fair value of the equity instrument cannot be estimated reliably, means that is not given to you in the question. So in such case, what do you have to do? Beta, we should have each and every situation with us. In rare cases, there may be a chance that the enterprise may be unable to estimate reliably the fair value of the equity instruments. Then what do you have to do? Then measure the equity instrument at their intrinsic value. What is the intrinsic value? That is normally known to every student because you have done it in financial management. You are in group 2 now. So group 2 mein to you know each and every about everything about your intrinsic value method. So in that case, intrinsic value will be used, which may be given to you in the question. Initially at the date of counterparty render services and subsequently at the end of each reporting period, at the rate of final statement, with any change in intrinsic value recognized in P&L account. Means what we will do? We will find out the intrinsic value of our equity instrument, and whatever change is there in that intrinsic value, that will be assumed as a loss for us. Means when face value is not given, then we may go for intrinsic value method, because in that case intrinsic value will be the better option for us. So in the given question, he says expected forfeiture per share is 3%. Forfeiture means for unvested, means those whose options are lapsed, who will not purchase the shares. Forfeiture का मतलब आप सभी को पुराना पता है, क्या मतलब होता था कि जब हमारे पास शेयर जो हमें मिलने होते थे वो लोग नहीं लेते थे, हमारे जब हम शेयर इशू करते थे लोग नहीं लेते तो उसे forfeiture कह जाते थे. So when the person doesn't take your shares, that is called forfeiture. The same concept is in the given case. He says 3% forfeiture will be there in every year. So how much period is there? There are 3 years. Vesting period is 3 years. So every year there will be a 3% forfeiture. The option granted vest according to the graded schedule of 25%. He say at the end of first year 25% shares will be issued. At the end of second year 25% further shares will be issued. Remaining 50% will be issued at the end of third year. We have to calculate total compensation expense for the options expected to vest and cost and cumulative cost to be recognized at the end of all the 3 years, assuming that expected forfeiture rate doesn't change during the vesting period when the intrinsic value at the option at the grant date is ₹7 per option. So intrinsic value is given to you. Instead of face value, this is instead of fair value, intrinsic value is given in this question. So the loss will be considered at ₹7 because intrinsic value per option is ₹7. So you may note it down. Intrinsic value will be replaced by instead of face value if face value is not given. If face value is not given, intrinsic value will be used. You may write like this also. So how to do this question? Let's do it. First of all, he says total shares are how much? Total options $600 into 1,000. So it's 6 lakh. It's 6 lakh. At the end of first year, 25%. Then at the end of next year, 25%. Then at the end of at the end, it will be 50%. Six lakh options are there. 25% will be opted in at the end of first year. 25% will be opted at the end of second year, and 50% will be opted at the end of third year that he is mentioning you. Now the important point is that how it will be calculated in a proper way, because we have to calculate it according to the forfeiture also. He says every year there will be a forfeiture also. How much is the forfeiture? That is 3%. 3% is the forfeiture. No? So it means for at the end of first year, how much share will be, option will be exercised by the employees at the end of first year. $6 lakh into 25%. It's equal to 1,50,000. He says minus 3%. 3% will not be exercised by the shareholders, by the employees, sorry, 1,45,500. So employee will go for 1,45,500 shares at the end of first year. Means at the end of first year, these shares will be acquired by the employees. That is given. Option granted vest according to a graded schedule. He says graded schedule is there. 25% at the end of first year, 25% at the end of second year. So at the end of second year, it will be 6 lakh into 25%. That is 1,50,000. Now, out of this, 3% will be forfeited because this is in the second year. So out of this also forfeiture at the end of first year will be there. At the end of first year, whatever is left minus 3% forfeiture at the end of second year, because every year there is a forfeiture. This is too somehow difficult. I would like to explain it in different way. I think it will be difficult in this way. You may it was 6 lakh in total first year, first year. How much will be forfeited at the end of first year? Let's understand this. 3% will be forfeited. %3 forfeiture. So 3% means 18,000. So balance left will be 5,82,000. End of first year. Minus out of this how much will be vested? How much will be acquired? How much will be purchased? 25%. That will be 1,45,500. Balance is 4,36,500. Minus forfeiture, because second year treatments are started. Forfeiture 3%. Out of this 3% will be forfeited. This will be 13,95. So 4,23,405 will be left. Minus vested. He says 25% will be vested. Very easy and simple now. I'm trying to make it easy for you. In module, it is given to some in your suggested answer. It is given in some difficult way. So at the end of second year, after vesting, it is 3,17,554. Now minus 4. Now third year started. Third year. In third year again forfeiture. 3%. It is 9,527. So it is 3,08,027. Now this is a balance. to be vested. In third year, this will be vested. No, just a moment. Don't copy it. Minor error is there. Minor error is there. Just don't copy it. I'm just trying to make something new for you. So obviously, when we are trying to do something new, there may be minor problem. You should have to bear it up. Otherwise, you will be difficult. It will be difficult for you to solve otherwise. So this is first year calculation is with you. In the second year, what will happen? Minor changes are there. In the second year, obviously 6 lakh was the total share available with us. Minus 3% was deducted 18,000. So it will be 5,82,000. Minus 3% of this, because he says forfeiture will be out of the total. So 6 lakh का 3% हमें निकालना पड़ेगा. It will be 5,82,000. 18,000 minus हो गया, and then yes, it is 5,64,540, because it will be of total, na? It will be of the total one. So vested minus vested, how much will be vested? 5,64,540 into 25%. So vested will be 1,41,135. Yes, it will be 4,23,405 beta. So in third year, it will be again 3% will be deducted this, 3% will be this, and out of this, that is 5,64,540. we have to deduct further 3%. 564, 540 into 3%. It will be 1,69,000, so 16,936. 5,47,604. So on that 50% will be acquired. Two seventy three 802. So first year calculation is this, second year is this, third year is this. This is a one way. Second way is this one, which I have discussed. We can do it this way. 6 lakh into 25%, whatever it is. One lakh 45,500, and then 6 lakh into 25% again, because this will be the total. 1,50,000 minus 3% will be forfeited at the end of first year, minus 3% will be forfeited at the end of second year. So it will be 1,41,135, and at the end of third year it will be more easy even, into 50%. It is 3 lakh minus 3%, whatever is there, minus 3%, whatever is there, minus 3%. You may get it. 3 lakh minus 3%, minus 3%, minus 3%. Minus 3%, minus 3%, minus 3%. 273,802. So what is good for you, you may check it out. So two ways of doing it. One is you may make it like this, 25%, 25% and 50%. Out of this 3% will be forfeited in the first year, and then 3% in the second year. So first year and second year both, out of whatever is vested, and then whatever 50% is to be vested in the last year, out of which 3% will be forfeited in first year, 3% in second year, 3% out of the balance in third year. So we have to make it categorized first. That is, this is 1,50,000. This is 1,50,000. This is 3 lakh. Keep it separate. We have to make it groups, make it in groups. 3 groups are to be framed. One group is 3%, second group is 2 years 3% each in cumulative way, and then third one 3% each. So finally we have to multiply it with 7. Whatever is the compensation expense is there, let's do it also on the new page. First year, second year, third year. Now vested, this is loss to be written off. So vested in first year is 1,45,500 into 7. This is to be written off in the first year only because this is vested in first year. So first year loss 10,18,500. Now the loss which is on those options which have been vested in the second year is how much? You may see here, loss is 1,41,135 shares. So it will be 1 lakh total loss. You may write it बेटर है यहाँ पर हम एक कॉलम बना लें. इट्स बेटर इफ यू मेक ए कॉलम हियर ऑफ टोटल लॉस. I am keeping it here because I have to write it again otherwise. So total loss of first year is 10 lakh 18,500. Why? Because 1 lakh 45,500 shares will be issued in the first year. In the second year, 1 lakh 41,135 shares will be issued into 7. So this will be the loss. It will be 9 lakh 87,945. This is a total loss which is to be divided into 2 years, because obviously this loss is to be suffered in first and second both years. So 50% each will be written off. 4 lakh 93,972 and 4 lakh 93,973. And those which are opted in the third year are how much? These are 2,73,802. These options are exercised in the third year. So their total loss is 273,802 into 7. It is 19 lakh 16,614. This is to be written off within 3 years, because these options are exercised at the end of 3 years. So these will be divided by 3 and to be written off every year. 6,38,871. You may assume this is a combination of 3 questions in which 1,50,000 shares are those which are to be vested at the end of first year, 25% what you are saying, but out of it 3% are forfeited. This is the first point. This is just like first question which we are doing normally. So this loss will be written off within 1 year only. And then at the end of second year, those which are vested at the end of second year, their loss will be written off within 2 years. So total loss, you have to multiply it with 7 and calculate it. You may have to multiply it with 7 and calculate it. And then you have to multiply it with 7 and calculate total loss which has been suffered on third group. So you have categorized it into 3 groups. Loss of first group is written off within the first year only. Loss of second group is to be written off within 2 years, because these are vested within 2 years. So the vesting period is 2 years, hence the loss will be written off within 2 years. And third one, its vesting period is 3 years, so the loss, total loss which we have suffered will be written off within 3 years. So at the end of first year, 3 groups are there to be written off. So total loss will be after adding these at the end of first year, at the end of second year, at the end of third year. So is that clear, students? Only this question is left, sir. Explain, sir. Tell me if there is any doubt to anyone. Any doubt to anyone? This is something technical, but this is a good question from examination point of view also. Just tell me if there is any doubt. Abhijit, is that clear? Abhijit Kohli, is that clear? Ilavarasi. In illustration number 7, during the third year end, the exercise price is only ₹30. Why we pass entry for ₹40? Exercise price is 30 if target is achieved. Target means if we will earn that much profit, whatever we are expecting, that is 10% per annum. If our income will decrease from 10% per annum, then obviously our fair value price, our purchase price will increase to 40. That has been given specifically in the question, beta. You must have to read the question once again. The question, in the question, there are two prices which are given at which these shares will be given. Price will be 40 if average earning will be 10% per annum. If average earning decrease from 10% per annum, then the price will be 30. So at the end of first year, we have earned more than 10%. So we are expecting that the price will be 30. So return of losses accordingly. At the end of second year, again earning is good. So due to that reason, we have expected that our profit will be average 10% for the 3 years. So we have written off losses according to the price of rupees 30. At the end of third year, what happened? At the end of third year, we have earned only 3%, and the average earning decreased to 9.33, which I have given in the question, given in the solution. So that is 9.33%. Due to that reason, price has been decreased. Price has been increased because we have given the option to our employees that if they will work hard and earn handsome earnings, then we will give them the shares at lower price. If they will not earn handsome earning, then obviously they will be given options at higher price, that is 40 and 30. So due to that reason, in this case, shares are issued at 40 in the last year, because in the last year we come to know that average earning has decreased from 10% per annum, which we are expecting. That I have done for you. Average earning is 10%, so issue price is 30. In the next year, average earning is again 10%, more than 10%, so there is no problem. But in the third year, average earning is less than 10%. How? We have calculated 12 plus 13 plus 3 divided by 3. So it is 9.33. It is less than 10%. Due to that reason, now the issue price will be 40 and maximum loss to be borne will be 12. So this has been changed. Abhijit, is that clear? I am waiting for you. Or could I explain it again? Total of this question, so this is the amount to be written off in employee expense account. Now in this case, when these shares are issued, then entry will be directly transferred to expense account. You must have to consider this thing also in this question. Next class will be on Wednesday, beta. Sonu, next class will be on Wednesday. Don't worry. One more important thing is there. Just like in illustration number 1, what we have to do in this question, when the shares are issued at the end of first year, we have to pass entry stock option expense debit to share capital to security premium. Means these shares are issued according to this 1,45,500. So this loss will be 10,18,500. No need of creating reserve for this because this has been done in the same year. In addition to this, for the remaining amounts, you have to create reserve. Means you have to create reserve for these two amounts only. employee stock option expense account debit to employee stock compensation outstanding account. These two amounts will be kept as a reserve because these will be carried forward to the next year. $1130 to $843. This is another good thing in this question. This is also beauty of this question, that this entry will be passed in this way. Bank account debit, the price at which shares will be issued if the price is given to you. In this case, price is maybe not given to you. The price at which shares will be issued is not given to you. If it is given to you, then we have to do in this way. Any other doubt to anyone? Now, examination question may, any other question? Yes. Another two questions are there. Yeah. The company grant 2,000 stock option on 1st of April at ₹60 when the market price is 170. 2.5 is the vesting period and exercise period is 1 year. So this is a question which has come into your exam. You may see that this type of questions we have already done. So you can easily attempt this question in your exam. Do it yourself. It will be better for you. So one question is this. This has come in December 2021 exams. This has come in July 2021 exam. Also, you may do more questions by going to your examination questions which has been given on ICAI website also. In your portal also it may be given to you. You may find out the questions of employee stock options and do that. More and more practice is always required. So today's lecture is over. We'll meet with the buyback of shares in the next lecture. Okay then. Thank you very much, Peter. Sir, would we close the session? Ramji? Ramji, could we close the session?